Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, learn some of their lessons learned, get some of their insights into the current market environments, and see how they're applying their toolkit to this evolving and quite volatile market conditions here in 2025. Great guest today, Jessica Inskip. Jessica is the Director of Investment Research at stockbrokers.com. She's also the co-host of the Market Make Her podcast. That's Market Make Her, Makeher podcast, empowering women investors. And Jessica, I've known Jessica for a number of years now. I've interviewed her before, and I've always found she is fantastic at applying, sort of a very straightforward, very level-headed approach to understanding the markets. I think you'll hear as we start talking about stocks and bonds and cryptocurrencies and a bunch of other topics. She does a great job of taking what at times can be very complex and confusing subject matter and describe it in very straightforward detail, which is something I think we all could do better with. We talked about some of the things that individual investors get wrong, some of the things that they struggle with in her perspective, and what they can do to upgrade it. And it has to do with really the level of detail, and I guess the level at which you're analyzing the markets. I'll let her explain in particular what she thinks investors could do a little bit better. Talk about the S&P 500 and the ceiling of uncertainty, as she calls it, pretty much right about where we're at now in early June of 2025. What it means that the market is almost round-tripped up to its February all-time high. Outlook for the S&P 500 and the NASDAQ. Talked about leadership, particularly growth stocks continuing to dominate, the lack of participation from small caps, from value-oriented stocks. We talked about interest rates, and I think her comments on the dangerous environment of increasing yields and just different ways to think about the relationship between stocks and bonds was super helpful. I found a lot of investors try to oversimplify and just think if bonds go up, that means XYZ for stocks, or something about interest rates or whatever. What you have to remember is these are complex relationships. They're not simple relationships as much as we want them to be. So in her comments, I think she did a great job in her comments of focusing on the narrative now, what it means or what it could mean right now if we see higher or lower rates, and what levels she's looking for on the 10-year. We talked about Bitcoin and other cryptocurrencies, the long-term thesis in some of those markets, and how to relate the fundamental and macro perspective on something like Bitcoin versus the charts and the technical inputs as well. Finally, I asked her at the end some of the risks that she thinks are most pressing right now. I thought her answers were spot on with two things she's looking at, kind of related to the consumer and their sentiment and behavior. Really great conversation here, and I hope you enjoy this interview with Jessica Inskip. She's the Director of Investment Research at stockbrokers.com. Super excited to be sitting down with Jessica Inskip. Jessica is the Director of Investor Research at stockbrokers.com. Jessica, it's been a little while, but it's good to see you again. How have you been?
It's been so great to see you, Dave. It has been a while. I've been great. We both have new ventures, so
Yeah.
I'm very excited to be on your podcast, and we will get you on mine one day as well.
I would be happy to do it anytime you'd like me to do so. But listen, really excited to have you on the show today. Plenty going on market-wise that I know we can talk about. I'd love to start just a little high level. When I think about you and just the journey I've seen you go on in your career, you focus more and more, I think, with your work on stockbrokers.com, with your podcast called Market Maker, and with your social media, you're really focusing on, I think, educating and empowering individual investors to just understand what's going on in the markets and just be able to talk about them in a reasonable way. I'd love to just start off high level. Like, what do you think individual investors tend to get wrong, or what do you think is the biggest frustration they're facing, and how are you trying to address that?
Oh, I think that's a beautiful question. I really think it's focusing on the why and not understanding the why behind market moves. And
Mm,
a great example of that, this actually happened this last week. There's a lot happening in the market, so it all merges together.
right.
But the yield curve is steepening. and we're getting higher yields on the 10-year, higher yields on the 30, and then there was that nasty auction on the 20. Normally, when we see the yield curve steepening, one would think, oh, there's going to be growth within the economy because that's what we've learned. But if we don't focus on the why the yield curve is steepening, then we don't actually understand. You can't just assume. We have to understand the components behind it or that second level thinking. And that's what people miss.
Mm,
Why is it steepening? Well, why? How it's a function of supply and demand. So they work inversely. If there's a big supply of treasuries or there's big selling of treasuries, that's going to make yields go up. And treasuries are comprised of our deficit. Well, if we have some deficit concerns, and that's the reason why yields are increasing and then decoupling from the dollar. So focusing on the why is going to help you understand what's happening with the markets. And instead of just focusing on, okay, what's moving by how much, if we get why, then you can start being very strategic with tactical asset allocation and even
yeah.
your overall portfolio.
I feel like so many investors, and honestly, not just individuals, but professional investors as well, try so desperately to just have very simple relationships, right?
Yes.
Interest rates go up, that's good. And it's just like full stop. And so they're just looking at kind of a basic comparison and sort of leave it there. And I think to your point, you're absolutely right. And I hope and certainly what I've seen of your work, you're trying to help people make that connection. So thanks for fighting the good fight and helping people connect to that second level of thinking. If
Of
we
course.
can, let's talk about the market environments. You started us off talking about interest rates. The 10-year yield sort of accelerated higher, right? In
Mhm.
April, now into May, and now into early June. It's pulled back a little bit as bonds have rallied. Can you talk a little bit more about this interest rate environment, what it tells you about conditions here, as obviously risk assets are doing quite well also? What does it tell you that you're seeing that move higher in rates as stocks are rallying as well?
Yeah, so I think we have to look at not only how high we're moving in rates, but the velocity of that. And the
Mm,
velocity of that has been volatility. We talk about volatility in the stock market. We also have volatility in the bond market. And volatility in the bond market is arguably a little more important because it's a bigger market.
yeah.
So the move was really fast. I think it's great to pull up the charts on that. I think the danger zone, I want to call it, is 4.8, but
Mm,
4.5 on the 10-year is where there's just some domino effects of pressures that happen. I like to describe it in my fun way. It's like a love triangle. If you start getting yields that are over 4.5%, that's considered a risk free asset, quote unquote. So if you're comparing that to the stock market, well, now treasuries are looking a little more attractive. And so that could be an influx of perhaps demand. So if they're looking more attractive, sell off on equities. Where is it going? Possibly into treasuries. That's one part of the equation, but it also pressures profit margins because that figure, the 10-year specifically, goes into a lot of valuation models, that discount cash flow models that then come up with those forward PE ratios that you hear finance media speak about all the time. And if we do math, if you have uh, a higher new or denominator there, you're going to really adjust the picture and it's going to
yeah.
bring earnings down. So there is a lot that happens, but it has to, I think we have to focus on the why, like I tried to say there. And the why here in this case is the treasury market more attractive than the equity market? When that
Mm.
happens, how is that affecting valuation models? When that occurs, that adds to this uncertainty equation that we don't know what's going to happen with earnings. And now we can't evaluate it with models because this is an input. What's happening here? And really it's uncertainty. Uncertainty is really filtering into absolutely everything at this point.
I feel like the word uncertainty comes up many times in my analysis of the markets here in 2025. I'm sure
Yes,
you're
it is.
probably experiencing a similar phenomenon. You shared this chart, Jessica, with the S&P 500. This is a weekly chart that you shared, and I love
Mhm.
some of the ways you're describing this. You describe a ceiling of uncertainty, which I can't help but notice we're kind of right up against it. Can you talk about the weekly chart of the S&P, how that kind of lays out the experience so far in 2025? What does that mean for where we're at today here?
Yeah. So I have, as you know, I do a little bit of a different view on my technical analysis that's not so traditional, but it's the way that I like to look at the markets, and it is a longer term view. we look at the markets quarterly because earnings are happening quarterly. The market is a forward-looking machine. We're always trying to anticipate what the price of this company is worth, hence why buyers and sellers come in and it's constantly searching for price. So if we can look at the study of price where technical analysis comes in, that's why I look at the 13, 26, and 40 weekly moving averages, because those equate to roughly 1 quarter, 2 quarters, and 3 quarters worth of prices. That gives me what I like to call the trend or the trading cycle. And then the 200 weekly I layer on for the broader secular trend, if you will, which is
Sure.
bullish if we really zoom out. But what's interesting, and as you can see here, and if you were to plot this on a chart and just go back, I really love utilizing this. When the moving averages, as you know, in technical analysis, we look at the slope of the line to indicate trend going up. We can see that. We also utilize it as mechanisms of support and resistance. When those averages are acting as support, that is our bullish trading cycle. The second we get into consolidation, going into those Dow theories, and we start losing those defense lines, then all of a sudden there's red flags, and those are signals in my mind. And that started when the first tariff was announced.
Mm.
We've got that. There was a couple before that, but our consistent closes below really
Yep.
started there. And then we've got those red candles coming in, but you can see how we broke all the major moving averages or the quarterly moving averages. And then once that occurs, that's when I see a really big drawdown. You can see the same thing during COVID or any of the major markets. That same trend always happens. And then, of course, we look for the reverse, which is almost happening now, but we have this ceiling of uncertainty where that we first fell below those moving averages. That's just creating this stop on the market. And it equates back into the why. We don't have clarity on tariffs. We don't know the impact that it will have on inflation. We don't know that the impact that it will have on consumers. And ultimately, we're looking at the stock market, this forward looking machine. We're a consumer economy. We want to see people are spending. If you and I don't know what's going to happen with inflation, if businesses don't know what's going to happen with inflation and tariffs and all the subsequent things, we can't plan. If we can't plan and we can't prepare, well, then we can't make decisions. And so that creates uncertainty, as in we need clarity. And I believe the market also is demanding clarity before it will give us anything higher.
I mean, I know we can't predict the future. That's not the business we're in as much as we want to, but I mean, it's hard to imagine an environment anytime soon where we're going to get a lot of clarity, right? I mean, it feels like that. This feels like a mirage right now.
I
So
agree.
we're left with, I guess, analyzing price action and what's happening. And I love this way of laying it out on the weekly chart with these longer term moving averages, just as a way of just, demonstrating the overall trend. Now, one of the characteristics of this market coming off of that low in April to where we're at now is really sort of a resurgence in the growth trade, right? There have been
Mhm.
times where we've talked about like value stocks sort of reemerging in a leadership role, and we've seen that on a limited basis, but really not much. I feel like we're still watching the Magnificent Seven, Meta, and Nvidia, and others, and seeing if they break out. Are growth stocks, is that still the area where you feel like is the place to be looking for opportunities? Or how are, given this ceiling of uncertainty, what do we do now besides just hold our breath and wait, I guess?
Well, you're right. It's impossible to predict markets. I always say we can't time markets, but we can prepare. And preparing
Mm,
starts with understanding. And which is all people who follow technical analysts or think about technical analysis, they always think time the markets, and that's not what we do. We analyze trend. Nonetheless, I agree with you there. I think there is opportunity in growth, and there is a lot
mm,
of thoughts behind that. One, we have a very growth oriented S&P 500, but that growth is
mm,
fueled by something we don't understand but are getting more clarity on, which is artificial intelligence.
mm,
That solved a lot of problems. If we think about the onset of inflation, part of it was a people problem. We didn't have enough people in comparison to job openings. And so
mm,
that means the consumer was really in control, and that led to wage inflation. That was one component of the problem. A solution to that is, of course, reducing your operating expenses or driving efficiencies, which artificial intelligence just came right at the right time. And I believe that's why we had that really narrow rally. If you recall, that was just driven by that magnificent seven. If we did not have that AI, and if you look at the S&P equal weight, for example, or just even
Mm,
strip out magnificent seven, there's no earnings growth. We would have probably had a recession called
right.
or something of that nature. So I think there's still opportunity and growth because that's not done. Even
Mm,
in that time, we had a restrictive Fed. When we have a restrictive Fed, we're putting constraint on the consumer, we're putting constraint on businesses. The intent is to start slowing down demand.
right.
And that survived slowing down demand because there's still this need for efficiencies. And now there's this race to artificial general intelligence. There's fingerprints everywhere. And on top of that, we've got this shifting market dynamics. Retail trade participation has overtaken institutional market participation, which means we have to pay attention to what retail traders are doing, and their fingerprints are all over growth. They like to buy the dip. And that is where technical analysis really, really is helpful as well.
So it's such an interesting point, and I was trained, and it's horrible to even suggest that this is what we would call these cohorts of investors. There was the smart money and the dumb money, and the
Mhm.
smart money are all the institutions, and the dumb money is all the retail investors. And now, in 2025, we're in a condition where retail investors, to your point, in a lot of markets, are the dominant force, right? So, what sort of ways, or what sort of, I guess, patterns do you see in the rally off the April lows that suggest to you that retail trading is becoming more dominant? Besides just the numbers that we're seeing, is there anything you see in terms of the behavior? What does that mean if it's more retail dominated? What does that mean for price action going forward? What should we be looking for? Does that make sense?
Yeah. So, as you're well aware, everything's a function of supply and demand. So, we want to
Mm,
know where the demand is coming from. And if you think about institutional traders, they will not be so over heavy in tech, right? If there's a rally in tech, we're going to rebalance, we're going to sell, and then we're going to bring up the others. So we have that asset allocation, or if they're looking to seek alpha, they're not going to be so overly concentrated on one specific security or one specific cohort because
mm,
that's not responsible. It's an
right.
aggressive, it's just institutional, right?
Mm,
And the retail trader are a younger generation, so having a more aggressive risk tolerance and really entered this market with GameStop. And that is I
That's your
know
introduction to investing, right?
that it was. And it was a good and bad way to be introduced to investing. I don't know. I'm an optimist. I see the glass half full, no
Okay,
matter what you
okay.
throw at me. So, um, but they didn't know how market mechanics work. Not all of them, but a lot of them. And so there's this interesting study I read at my time at Merrill from Deloitte,
Mm,
where this newer generation did not have trust in corporations and just saw them not as your friend, not as your enemy, but they just weren't looking out for you. And that
mm,
put the puzzle together for me with GME because I read that before GME came out. And when GME occurred, you had these investors who thought that they were beating the market. They created this squeeze because they were holding the line and forcing a big hedge fund, that institutional side, to make a move. And that made them
mm,
feel powerful. And if you remember back in the day, I started finance in 2009, and we would once in a while I'd speak to clients who would hand me letters that were those old pump and dump schemes where they'd I'm talking about. This
nice.
to me is almost a newer innovative version of that on Wall Street
Right.
Bets. But nonetheless, there was this adrenaline rush, and therefore they wanted
Mm,
to get that more and more. So this, oh, if I just buy now, it will always come back. It will always come back. The S&P 500 will always come back is a trending thing, and there's reasons behind that. So what we have to pay attention to, it's very different because one, market mechanics change, frameworks change. This is a market mechanic shift and change. Fed frameworks change. We have to adjust and understand it. And I think about the influx of social media. The way that algorithms are designed are to hold your attention. And if you find it interesting and then more people find it interesting, it'll push it out to more people like a wave. TikTok describes it as a wave. They see something as a little splash, and then it moves to a wave, and then it moves to a tsunami. If you can find
Yeah.
those tsunami moments, but if you think about that, that's a lot of people. That's where a trend is. If we could put that on a chart, and but you can pull those on TikTok, and one of the things trending at this moment are buy the dip. And so,
Yeah.
meaning that's what we'd have to pay attention to is where is this mentality coming from? Where is retail demand, and where can we gather that? And there's indices from some of the brokerage firms. You can see their orders and things like that. So there's a lot of data in different places we can pull together, but it's newer. So there isn't a centralized system for it.
Right. Speaking of younger investors with risk-seeking behavior, if for lack of a better term, let's talk about cryptocurrencies for a moment. Right, we're in the situation where the S&P and the Nasdaq sort of attempting to gain momentum up to their previous highs. You have Bitcoin pushing to
Mhm.
new all-time highs here in the last month, and from a technical perspective, appears pretty constructive. What's your take on cryptocurrencies here? Because, part of the technical toolkit would say we're retesting previous highs. Maybe this is where we sort of take a dramatic pause. Have we seen enough of a pause in charts like Bitcoin, in your opinion?
So I do think we're at that area of resistance. And I think then we have areas of resistance, which are just areas of supply. We need to see, will demand overcome that, and what will bring in demand? We need a catalyst. So
Yeah.
that's when I turn to the why, or what's happening around cryptocurrencies. And I think it is so interesting. So we've had a shift in the administration. We now have a new SEC chair. That SEC chair is very pro tokenization, very pro crypto. And if that happens, and he's also very pro in a bipartisan way, which means there is much higher chances of that getting across the line. So now
Yeah.
we've got shifts where there is more ETFs coming out. If there's more ETFs, there's more demand for creation of that. Then there's also this acceptance that it's a security, and then there's competition. So then there's other ETFs, and we've kind of seen that play out. But what I think is even more interesting related to the crypto is the blockchain and the tokenization and these AI SARs, or even things coming out of the administration's mouth like stablecoin or these meme coins. But I think it's important to bring that up, agree with it or disagree with it, because it's what fiscal policy is showing up. There are
Mm.
acts going through with this information. Actually, I believe they're being discussed this week.
Yeah.
And so if we see a stable coin or something like that that is related to this type of technology, that's the type of catalyst that could help push us past that resistance. So as a chartist, we're going to look at that and say, oh, here's my stopping point. I'm going to wait. I need to understand how can there be further demand. And I think it's great to just bring harmony into those two.
No, there's a lot of really good points in there, Jessica. And I would say you're right. I mean, there's a big difference between where we're at now with an administration that certainly seems very, in, I guess, positioning themselves certainly for a growth in cryptocurrencies with strategic reserves, et cetera, et cetera. But great points on combining sort of the thematic backdrop with that, with the technical outlook as well. What I loved, I mean, we've talked about some of these markets that have had some pretty good runs, right? Cryptocurrency stocks and elsewhere. What concerns you? You seem like a pretty optimistic,
Yeah.
analyst when you and I talk. What concerns you right now? What do you think is the biggest risk in your opinion? Is it rates sort of hit that breaking point where all of a sudden you feel like, okay, this is now a dangerous environment? What is the, sort of that red flag chart or signal that you're looking for here?
So I have two headwinds that I'm just cognizant of and wary of. One, I think it's on the consumer.
Mm,
There are, and I think it's, if you've ever, I encourage you to do this at some point, Dave, but it'll take you down a rabbit hole. You can take the Fred data and add it as a plugin to Excel, and then create all the charting on it. So we can analyze economic
that's a
data.
nightmare of amazing data to go through, I'm sure. Okay.
It is, well, fun for me, but nonetheless. But
Okay.
just like we have different sectors within the market, and we're going to look at that, we also have different cohorts of consumer. We've got the lower end, middle, upper, the way that we categorize them, and there's lots of data around that. And I've noticed some headlines coming across. So even pulling charts on Campbell's soup, for example, that's doing really, really well, but it's
Yeah.
because the lower income consumer is constrained and they're going towards canned foods.
Right.
Snacks is down, but canned foods is up. That to me is a
Mm.
very concerning headline. We look at continuing claims on the job market versus initial claims. It looks like the labor is being hoarded, which is something that happened during COVID. So they're not hiring, they're not necessarily firing, but the trend, it looks like it's about to shift. That portion of consolidation we get before a trend shift. So my big concern is constraint on the consumer, because if we look at recessions and we can do all the studies we want on recessions, there's one thing that goes hand in hand with a recession, and that's mass layoffs.
Mm.
And I think there's other things that could buoyant that. It might be skewed where our consumption base is, it makes up 70% of GDP. If that's by a wealthier individual, well, does it matter? Yes, to a certain cohort, but it just looking objectively at the totality of the data, it doesn't make too much of an impact. So
Sure.
once that starts and seeps into the middle class, and that's a problem. But then we've got housing, you can see cracks there, but that's also good. We need housing prices to go down. Um, lots there. So that's one concern I have.
Yeah.
Almost related from the housing side is our deficit. That's not a sustainable path.
Yeah.
But I think that also goes back to what I see this administration is doing. One, the lack of demand could be a concern. We've got a lot of issuance rolling over in July. And if there's no one to buy that, who's going to do that? Probably the Fed. But then I
Mm.
think about stable coins and how they work. It's kind of like a mutual fund or a money market fund. If those stable coins are all pegged by treasuries, well, then that's demand for treasuries that's going to come in. And maybe that's going to be a temporary band aid in the situation. But my concern is what's happening in the treasury market, because that impacts you and I, consumers, what we borrow,
Yeah.
our what we spend. So many things, if people participate in the market or not, the credit market impacts you, period. So
Yeah.
that it's all this domino effect. So a lot on my mind. I hope I got that across. Okay.
No, I think those are two really good points, and 100% right. I haven't done that deep dive on the consumer data, but as you're talking about it now, I'm intrigued, and I may go down the rabbit hole a bit, because it'd be interesting to see. I mean, that's what you're trying to dig into, right? With consumer sentiment is whether you're seeing signs of optimism or desperation, and the data could support that. I really like your comments about the bond markets. I feel like there was a time when it felt like individual investors, stock and ETF investors, didn't need to worry too much about the bond markets. They're kind of fine. I don't feel like this is one of those times. I feel like this is one of those times where it's at your own peril to avoid those areas of the market. A lot of information there. Jessica, this was a lot of fun. I hope this is not the last time you and I are able to chat. I hope we can keep in touch and do this again. But in the meantime, congrats on the role at stockbrokers.com. Wish you well there, and with the Market Maker podcast as well. But thanks again for coming on today.
Yeah, it was my pleasure. Thank you so much for having me, Dave. I'd be happy to come back. Just let me know.
I hope you enjoyed that discussion with Jessica. She's a lot of fun to talk to. And from when I first interviewed her, she's had experience similar to me working at some larger financial institutions. She's worked more on the retail side, working with retail investors. And I think it shows. She does such a great job of taking the complex financial markets in 2025 and simplifying and making them very much more understandable, which is something I certainly try to do in my own work. And I think we are kindred spirits along that way. But I think Jessica does a fantastic job of focusing on key data points. I really love her comments about looking for sort of that second level of thinking. So often, headlines and a lot of market commentary focuses on sort of that top level, right? Sort of that headline level of information. And her point, if you really want to understand the relationship between stocks and bonds or cryptocurrencies with the more fundamental and the more technical components, you have to think sort of another level down. And I thought some of her comments along those lines were really well said. Loved her comments, particularly on the interest rate environments. I would wholeheartedly agree. You probably picked up on that theme from a number of my guests. We've talked with portfolio managers who are focused on the fixed income markets. We've talked about equity strategists that are talking about fixed income. People like Yuri and Timmer, global macro strategists. All of those people that I just mentioned talk about the importance of interest rates, the importance of the yield curve, sort of related to that, the trends in the dollar. And I think that is an appropriate way, and I think Jessica hit on that pretty well, which is the importance of focusing on rates and what they might mean for investors. Certainly what they mean for the consumer, and I thought her comments at the end about risk, areas that she's focused on are things that, keep you up at night, and focusing on consumers, what we can learn from digging into the consumer data a little more deeply. I thought that was very, very interesting. So that was a great interview from Jessica Inskip. You can find more information about Jessica and her work at stockbrokers.com. Also check out her podcast called Market Maker, Makeher. That's it for today's episode. Do want to let you know of some of the work we talked about, looking at charts, talking about the trends in Bitcoin and the S&P and growth stocks and all the other charts that we reviewed during the course of this discussion. If you want to supercharge your own use and mastery of the technical analysis toolkit, our Market Misbehavior premium memberships may be a great opportunity for you. 3 great benefits to the premium membership. First off, you'll have access to some virtual courses that will help you understand behavioral biases, what's happening between your ears, and technical analysis, a practical set of tools that you can use to understand the world around you as an investor. Second benefit would be our premium members only reports, like our weekly flight plan, where we focus on what we learned in the week that just happened, focus on key levels, patterns, and signals in the week to come. Also, our monthly chart review, where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our members-only community. This is where you can ask questions of me. This is where you can learn from some of the questions that our other premium members are asking. Think of it as a supportive community of like-minded investors trying to navigate these markets using behavioral and technical approaches and helping each other out along the way. For more information on our premium memberships, make sure you go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That's it for today. Thanks so much for joining me here on the Market Misbehavior podcast. My name is Dave Keller, reminding you that it's always a good time to own good charts.